Welcome back to Pocket Pundits. I'm Matt Pappas, CEO of Cottonwood Wealth Strategies. So today we're looking at one of the biggest shifts underway in personal finance, the great wealth transfer. Trillions of dollars are moving from baby boomers to their kids and grandkids over the next few years through 2048. Now that shift is changing what families, what we call rising inheritors, and first generation builders expect from financial advisors. They want clear planning, personalization, and transparent digital experience, not just market takes. And in fact, we're seeing that in the data. Many high net worth investors say they plan to change or add wealth management relationships in the next 12 to 24 months, a sign that people are voting with their dollars. And at the same time, many veteran advisors in our industry are retiring, and a new wave is stepping in with updated tools and a different client experience, meeting expectations in new ways. And from parents to grandparents, we're hearing a consistent question. How do I prepare my kids and my grandkids to preserve and grow the inheritance rather than spend it quickly or let it sit idle? Now, to help unpack it all, I'm joined today by R. Scott Victoria, Chief Operating Officer at TradePMR, one of our long-term partners. Scott oversees the entire advisor experience, including products, operations, and advisor services. He also chairs the firm's business committee that sets strategic direction. He is a CFP, a University of Florida MBA, and in 2024 was honored with Wealth Solutions Report's Pathfinder Award for Hispanic COO of the Year. Now, there's been some recent, I would say, very exciting news around their organization, which we won't be covering today. Our focus will be purely educational, digging into topics like what the next generation actually wants from an advisor and how that differs from their parents, and the biggest education gaps around planning and long horizon investing, and how modern platforms and advisor models can support a clearer, more transparent client experience. So Scott, thank you so much for joining us today. Let's get started. Let's talk about the next generation of wealth. So let's kick it off with the headline, right? We're seeing a lot of different expectations from rising inheritors and first gen builders. They want speed, they want clarity, they want proactive planning, right? Now, you and your team at TradePMR work with 350 plus RIAs across the country. So from your vantage point, overseeing the advisor experience, what feels most different to you about this next gen client?
Hi, Matt. Thanks for having me on, and what a great introduction. I appreciate that. I'm glad to be here. So to your question, first, I think it starts with speed and just responsiveness. The world has certainly gotten faster. I certainly expect when I'm a client, just real-time digital experiences. I mean, first things that come to mind are mobile banking. Think Zelle, think Venmo, PayPal, all that kind of stuff. And then that translates more specifically to our side, in trading apps. You can think of some pretty good trading apps that retail clients are using because they want to do those more routine things that don't involve, in this case, an advisor of themselves. And so they want that speed, that responsiveness. They expect advisors to deliver many of those same things to them as well when they're interacting in an institutional advisory capacity. Think things like streamlined onboarding, right? They don't want to take week-long delays, and then the tolerance for back and forth of paperwork is just not there. So you got to make sure you have digital signatures, those nice customer portals, and then a seamless integration connecting all of these tools that we as advisors use in this ecosystem is just the baseline. So I'd say that's number one, is kind of speed and responsiveness at which clients are expecting. Another thing that I think clients are expecting, especially the next gen, is being proactive, right? We can no longer be reactive. We need to anticipate needs, liquidity events, a generational transfer. So that's one. I think that's being proactive is probably going to lead to better outcomes for advisors and clients. For advisors, winning loyalty is, I think, really what it comes out to. But then I'd say, Matt, personalization probably wins out as the number one thing, right? Clients do not want cookie cutter solutions. They want tailored advice specific to their unique journey. So advisors need to experience, what I was referencing before, and mirror the UI, UX of leading fintechs that these retail clients already use. I mean, I know that Uber and DoorDash know how much I want to tip already. And I think my wife will say that she loves that Netflix knows what I wants to watch, because I had the habit of just continuously browsing and never selecting a movie, and we just fall asleep, right? So these apps that, again, clients are already utilizing know that personalization almost better than we know ourselves, and that's what the institutional side and the advisor side need to really project and bring home.
I couldn't agree more. I mean, with the younger clients, a lot of them want simple things like secure messaging, right? More timely check-ins. How's their plan working in the background? We've got to evolve beyond the typical monthly, quarterly statements that I think people have been used to dealing with an advisor. To your point, it needs to be proactive. It needs to be personalized to what their situation is, not just tracking an index or a market or, again, how their performance is doing on a short-term basis, but what do the long-term goals look like? And how can I check in on those and see those real time, right? To your point, the digital interface, capturing all that information to, I would say simplify things, right? I think our industry does a really good job of complicating things. And I think in a lot of ways that loses people, right? We don't need to make things more difficult for folks. Yes, markets are evolving and the world is evolving, but a lot of times what we see is people they want to have a simple interface. Says, how am I doing? Am I on track or am I off track? And to your point, I think that's really, I think, going to accelerate with this next generation of client, but it benefits everybody. It benefits all generations. So I think we're kind of touching on friction points and difficulties that our industry needs to really evolve. What do you see next gen clients? If we had to pick, Scott, a couple of things, what do you see them most frustrated about, what advisors have traditionally done?
Well, first and foremost, there's not enough advisors. I mean, I think we got to start there, and so we may be relying on other things, but that may be a topic for a little bit later. The advisor space is just not going to grow enough. I think we're going to be forecasted to be 100,000 short of advisors in about 10 years. Now, the big question mark is, how much does AI help combat that, right? I don't think it's unrealistic for AI to really help maybe some efficiency gains of like 30-40%. So that should help, reduce that number, or that imbalance between supply of advisors and demand of clients and wealth management needs. But ultimately the right balance, I think, between the digital access and human coaching is probably going back to, and I always use it as my default, is the 80-20 rule. 80% of interactions are probably going to be expected, at least by the client, to be digital, right? So that they feel in control and informed at all times. And then you supplement that 80% with the 20% high impact human coaching moments. And I know that those seem kind of disproportionate, but I think that balance will ultimately win trust and loyalty. And you may be wondering, at least the listeners may be wondering, well, what does that high impact human coaching really mean? And I think that's helping navigate uncertainty. It's weighing the balances and trade-offs that, because nothing's absolute certain, right? So it's unpacking those options, because it really does come down to options. There's not just one choice. And so they want, again, the instant access through digital tools, but when it really matters, they want a human coach who helps them make better decisions with confidence. And that's where that human advice comes from that you and your firm provide, Matt.
I think that's spot on. I mean, you could also call it service plus or service and personalization, right? You mentioned things like trust and really building relationships with clients. I'll tell you, that's something I've learned from the veteran advisors, like my dad, for example, who's been my business partner for 15 years. At the end of the day, the non-negotiables with clients are still true today. Trust, personalization, transparency. We just need to deliver it in a more modern, interactive wrapper. And it also brings me to another point about one thing we really believe in is the family office experience. And that's largely been reserved to the ultra high net worth families. But in my opinion, it should be available to all successful families and entrepreneurs. So what does that mean? It means providing advice like what we're talking about and solutions beyond just money management. So to your point about the 80-20 rule, if the advisors are able to provide solutions digitally through that 80%, then we can focus our 20% on the really more meaningful items and really elevate that service experience for the end client. So more solutions, more transparency, more comprehensive view of what your plan looks like. That's really what family office means. It's really covering all those bases for the clients. And in my opinion, the next gen advisor in our industry is really going to be the one to provide that experience to clients. It's what we're seeing and hearing from the end clients. They're asking for it. I think it's on us to deliver it.
Absolutely, Matt. I mean, part of our working assumption is that an RIA right now is going to be a lot more like a family office, building more services and bundling them instead of the fragmentation, that we are right now, and really, having more options in-house reduces that operational complexity for both, frankly, the advisor and the client. And that's great. It's not just about investment management like it was 20 years ago. Providing that white glove service like concierge bill pay, cash flow management, heck, even lending solutions, and really taking into consideration multi-generational wealth and how that's going to play out is extremely important. Yeah, absolutely. I think AI and other technology advancements are going to allow advisors to just go into that more family office model that has been, reserved for the probably the top 1% of clients.
Yeah, and I know we're going to talk. I want to talk about AI and social media. I know we're going to get into that in the next segment, but I feel like all these things we're kind of talking about conceptually, really, they ultimately come down to the education piece, right? So when we talk about inheritance prep, it's really one of the most common questions we get as an advisor firm, from the older generations and even some of the younger generations, is how do I prepare my kids and grandkids and then their kids and grandkids for this inheritance? And it's really concerning, although I think there's an opportunity for us to really step in and help these families, because the reality is, we look at the data, the gap in education, it's eroding family assets, right? The kids and the grandkids inherit this money. They don't understand the purpose. They don't understand why it was set up this way. They don't understand the structures. And so a lot of times it sort of fizzles out or gets spent away, or assets underperform and all those kinds of things. And so moving from sort of expectations to education, Scott, where do you think the communication breakdown is happening between, I would say, older generations, but also advisors and next gen and clients?
Well, social media, God bless it. It used to just be about connecting with others, and it's evolved for better or worse. Many, especially next gen clients, but honestly, it's pervasive throughout generations, are getting information from social media now. But it leads to misinformation noise that then leads to anxiety, and they, being clients, want a professional to kind of siphon through the noise and get some verification and to be able to translate kind of what some things are said. A lot of things on social media for views are done as clickbait, right? Very inflammatory, maybe missing key portions, whether it be tax advice that completely misses eligibility or nuanced rules that can get clients in hot water if they just prescribe or listen to the surface level information that's provided. AI is great, but it's only as good as the information, one, that it has, two, the prompt and question, I guess, that you said that you would enter into the AI interface. Hopefully you're not omitting key information. And then ultimately, when you get that response, you better hope that the AI is not hallucinating. So that's, I think that's surmises the communication gap between advisor and clients a lot.
Yeah, I think, we were talking about this a little bit offline, but if we go back to like the financial crisis, that was a pivotal event for a lot of folks, right? Our generation experienced it differently than the older generation, but I think you could also safely say that it really eroded trust from clients of all generations with the traditional financial institutions. And I'm not going to pick on one, but there really is a lack of trust with those institutions. And maybe that's why we're seeing the increase in social media reliance, looking for other resources, looking for other options. I think I see this a lot, and you probably do as well with other advisors in our industry, but I think some advisors have just sort of shunned away from social media altogether, right? It's only for kids in their 20s and early 30s, and it's not a great information source. But I think it's incumbent upon us to actually lean into that. If they're looking for information on those resources, they're looking for pathways, like you're saying, to build that trust with an advisor. It's really on us to be on those frameworks and in those channels to get some good information in front of these folks. So I think advisors have not done a great job at that, but therein lies an opportunity, right? I think we can lean into those channels and be present to help those clients build trust with a trusted advisor in an industry where it's lacking.
Absolutely agree. I mean, the lack of trust in financial institutions is absolutely there. I think the tendency now is to trust individuals versus the institution. And so in the independent RIA space, what you just said is you got to fill the void, because if they're not getting information from trusted sources like a fiduciary independent RIA, then they're going to be getting it from just any old person talking head online, again, using very inflammatory statements to get clicks and views, etc. And so I absolutely agree with that proposition.
It kind of goes back to what we said earlier, right? It's personalization. And so if those influencers, whatever you want to call them, are putting out maybe some good tips and tricks, maybe some that are not bad, at the end of the day, it's not personalized for that end client or family. And so I think that's where the trust gap is going to come in. Again, it's not that all the messaging is bad, but we need to kind of step in and sort of bridge that gap, saying, yes, this is a good concept, or no, that's a bad concept. But at the end of the day, here's what it means for you. Here's what it means for your plan. Here's what you can take away from that.
Well said.
Well, I want to talk a little bit about, we're touching on things like AI and so forth, but tools, platforms, technologies. Right? We see it across the board in other industries. They're evolving very rapidly. I'm a firm believer that the financial industry is a little bit behind the curve, although I think, especially what you and your team are doing at TradePMR, and now the partnership with Robinhood is very interesting. I think it's very forward-looking. So let's talk a little bit about that. What are you seeing, Scott, that's maybe exciting in the platform world, or some things that people need to be thinking about?
On that, my responsibility here at TradePMR is really about the user experience, and that's both on the service side and technology side. And you got to have the right tools and the right service model, and it's not just us on the brokerage custody side. It clearly goes to the RIA model to service your clients. So execution only works when both the tech stack and the service model actually reinforce each other. You have to marry the two. Ultimately, families don't want more process. Nobody wants more process, whether it's an RIA or the end client. They want clear progress without additional burden. Some things to be able to carry that, for the listeners. I'm a big believer in defaults and kind of pre-commitments. And let me explain what those mean, right? So families often stall, myself included, by the way, on decisions, right? So setting default options that usually apply for, let's just say, again, going back to the 80-20 rule, 80% of the users think things like default savings rate, default tax loss harvesting, et cetera, just reduce decision fatigue. It's such a great thing, but we get tired of the day and the default answer is no, right? And so how do we get ourselves out of that rut? It's having defaults that are usually good, that obviously an advisor can fine tune. And then pre-committing is having a plan that is actually living and breathing, meaning if this happens, we are going to do this. It's already laid out. We already know what we're going to do. Hey, what happens if the market drops 10, 20%? What is our playbook, so that we don't get emotional in the moment? We've thought about this logically, calculated, and based on our plan, versus the in the moment decisions and very reactionary. I love those two things. And then we can go down to behavioral design cues, right? So things that we within our product are visual progress trackers, very important. So everybody knows where we are, whether with it's the request, journey within the plan, et cetera. I know you used on track, off track. I mean, those are things that are visually there so that they don't get lost in the noise. They need to be very simple. We like doing small wins, right? So we front load easy tasks, build momentum, think of like a snowball, right? It just keeps on getting bigger and bigger and bigger. And all of a sudden you have that momentum and conviction in whatever the plan was. And so we use that both, in the service model when we're putting, let's say, transitions together, financial advisors to TradePMR, but that is obviously easily used from advisor to client as well. And then, hey, gamification, it works. It keeps users engaged. I think badges, streaks, maybe even a family scorecard, get those competitive juices going so that you get the older, younger generations competing against each other, who can sign the documents first, right? It is a great tactic, perhaps, to get the ball moving.
No, I think that's great. And I mean, again, speaking from us at Cottonwood, having been partners with Trade for several years now, I mean, your team has been instrumental in helping, reduce that friction, right? That word we've been talking about a lot, but those pieces that you're talking about really do filter through the end client to have a better experience, so that we can focus more on the 20, the 80%. So we're enhancing both sides of it, but the 80% of it on the technology, the friction, transactions, money movement, all those sorts of things. It all flows into the end client experience, which is what we're all trying to do, right? So those tools I think are really important. I agree with you. I think they're going to continue to evolve. The gamification thing I think it's really interesting. I think it's just beginning. And I think it goes back to that simplification. Let's not make it more complex. Like you said, defaults, structures in place. You can even call them guardrails, where if we're putting those in place, somebody may say, well, you're not customizing it enough for the family. So I would say that's not true. We don't need to focus on that customization. It doesn't need to be customized for the client. We're putting guardrails in place so that we can focus on the value added services and solutions on that 20% side to really enhance the picture. And so it's exciting stuff. I mean, I think it really is. I think it's, we're talking a lot about lack of education and gaps, and I think those are certainly there, but I think for advisors who are interested, in helping folks, there's a lot of folks that are going to need help. There's a lot of folks that are going to need that guidance. And, as the end client, I would say you should be optimistic, because the tools, resources, and the service model, I think, are going to improve for you. And so that's a benefit, right? That's a benefit.
Yeah, we should not be scared. I mean, there are guardrails, like you mentioned. I'll put that, in really everything that involves technology, at least. But technology is really going to allow us to service a lot more individuals, and that's what it's going to be. That's what it's about: getting better outcomes for our customers, and we're going to be able to do that better for our existing customers, and we're going to be able to get more customers on this journey, financially literate, and better outcomes for their retirement or whatever their end goals are.
Absolutely. Well, Scott, this has been a fantastic conversation. I know our listeners are going to really enjoy this. Do you want to leave? I do want to get some questions in from our audience. We had a couple submissions. Let me jump to the first one. So I think this is a little more for Cottonwood, but one question came in. What's the one way to start preparing heirs this year without overcomplicating it? I think a good way to sort of exemplify this is, what we do at Cottonwood a lot is we recommend clients at a minimum start with what we call a 90-day playbook. And so what does the 90-day playbook look like? Well, first it starts off with organizing and de-risking the obvious. So ask simple questions like, where's the money held? Who owns private assets like real estate? If they own a business, what's the succession plan? What's the written succession plan, most importantly? Let's identify and organize those big items. Secondly, let's build a plan, and more importantly, build a service calendar. Where and how the assets are going to flow to the kids and the spouses. And, really think of it like a garden, right? Assets and cash flows need to be pruned, and they need to be reviewed regularly. And so we want to make sure we have that service calendar in place. And thirdly is really tax map and investment policy. So questions like, what's the purpose of holding these investments? How does this policy evolve? What's the long-term tax strategy to pass on those assets? So at the end of the day, right, we're bridging that education gap. So everybody's on the same page about how is this going to flow through, and so everybody's better protected. And fourth and lastly, I would say, we really recommend what we call a family meeting and a handoff. And so once we've sort of established the plan, we've laid out the framework, it's very clear and concise, everybody's on the same page. Now the path and the purpose become very clear and understandable, so that families feel much more confident that they're on the right path. They understand what the idea behind this inheritance is to do, and how they can protect and grow it into the future. And, this sounds really simplistic, but create a one-pager, right? Make sure you've got contacts, accounts, spending rules, windfalls, and including with that the snapshot of the family plan. so that's very quick and accessible for anybody in the family to kind of take a look at and say, hey, where are we at? What's going on? That's right. This is how this piece of it's supposed to flow. So that's something we recommend. I think is a real easy action plan for families. So Scott, this one I think would be a good one for you. From the lens of a parent or a grandparent, if I want my adult kids to be looped in, but I'm not ready to hand over the keys. So what permissions and tools should I ask an advisor or a custodian for my kids to see so they can see the plan and learn while we still protect the privacy and control over the strategy?
It's a good question. I guess I got to commend the person asking it, because they're doing the right thing, at least in my opinion, by being proactive in getting that second generation involved, at least to a certain degree, where it makes sense. My immediate response, what comes to mind, is first and foremost the access controls, like the view only access, to let those individuals, most likely kids, usually at least, see the balances, see performance, and track that progress so that they're engaged, obviously not initiating transactions. And then we talked about the second part, we talked about it earlier, which is the education piece. Are those individuals going to be ready when they assume, let's say, the role of trustee? So curated financial literacy programs or content libraries for that next generation family member. So when they get that responsibility, they know what position they're in, how it's played out over the last 5-10 years, that history building up to them taking the reins and going forward. I mean, to ultimately ask for role-based digital access, family dashboards, and the permissioning, whether that be documents or just account viewing, is where my head goes.
Yeah. I think, and I think historically a lot of families, especially older generations, have really had the mindset of, I'd call it protecting, right? I don't want to say not sharing because I don't think that's accurate, but really protecting information, keeping it, close to the chest, so to speak, and saying kind of the mindset is, I'll talk to the kids about it when we get there. But I think some things you hit on, right? Tools and family mapping and reporting and the digital tools specifically really allow parents to sort of break down those walls and share the important information, maybe not all the details that they want to share with the kids right now, but the important information to kind of bring them into the conversation, right? So that they understand how things are going to flow and how the strategy is going to work once they pass.
Yeah. And Matt, it may be well-intentioned, but life happens, and things obviously happen unexpectedly, and they don't have that ability to hand off at that precise moment that they want. So getting them involved a little bit earlier is usually the best course of action.
Totally agree. Yeah, I completely agree. I think we've got time for one more. And the question is, in a situation with an inherited single stock exposure and an active equity comp, this is really specific. What are the first process steps, including organization, risk, tax timing, that families can discuss with an advisor? And how do you show progress with without lots of long meetings? Great question. We're coming across, I would say, more families that have things like RSUs, restricted stock units, stock options, concentrated positions from companies that they've worked at for a number of years. And a lot of the questions we get are, am I over concentrated? Should I be doing something with this stock? And, at the onset, what we come across a lot is they're great ways to build wealth. And in most cases, they've worked with this company for decades. They've been along for the journey of that company growing. They've benefited, they've participated in that growth, which is fantastic. But now they're in a position where it's a big piece of their overall wealth. It's a big piece of the financial picture. There's tax complications in terms of we don't want to just liquidate it because it's going to create a lot of headaches. The way we've approached that, again, kind of going back to the framework of the 90-day playbook, if we're identifying those pieces of the financial plan and putting it in the structure, then we can lay out a strategy on a longer term basis. So let's think 5, 10, 15 years down the road to diversify that asset, to put it in other areas that are going to be value add, where it's going to grow and protect and preserve, but in a way that's tax managed. So that's why I made use the example of a longer term time horizon. I think in a lot of cases, folks kind of look at that and say, oh, it's too big in my portfolio. I've got to do something with it today. And it's not normally the case, right? If we've got a solid action plan, if we've got that family framework, like those are the tools and ways that we can visualize and the client can visualize how we're going to use that asset and what it's going to do for the next 15 to 20 years. And the second point of that, how do you show the progress report? And again, it's that action plan. It's the user interface, the digital interface that clients have access to now. That again, it's much more comprehensive. So we talked earlier about the friction points between being able to see, if I'm an end client, being able to see my total financial picture. Our industry, I think, has done a bad job of really giving that to clients, because you have to have all your assets in one institution. It's not looking at your private assets. Everybody's got real estate. Some people have investment properties. Like, all those things are components that we need to bring into the view. It doesn't mean that you should have to move them or shift them or change them to get fiduciary advice on how that all makes sense to the picture, right? And again, I think working with Scott, with your folks in TradePMR, I mean, you guys are very forward-looking in that. Really help, I think, teams like ours, companies like Cottonwood, reduce those friction points for the end client to give them a clearer picture, to help answer these questions, right? That's what we're all trying to do. I think that's all we have time for today. Scott, really appreciate you coming on the pod with us. I think this was a fantastic conversation. I think it's really timely. I think, quite honestly, you and I could probably talk for hours about this subject, being sort of next gen ourselves, right? Like, we're living it. We're seeing it with peers and so forth. But again, I don't. I want folks to kind of take away also that this is it's really a change affecting all demographics, not just next gen. It's not just younger clients, although I think they're the ones that are really driving this. But it's really, in my opinion, a call to action for advisor firms, providers, partners like TradePMR to sort of meet the need of what these clients are looking for. Because, Scott, to your point, there is an advisor shortage. There's a lack of trust. People are looking for guidance. And so I think the firms that really grab hold of that and take the opportunity to help people, we're going to be able to provide great advice and guidance and help families. I mean, that's the end goal. So I think it's very exciting.
Matt, couldn't agree with you more. I really appreciate you having me on. I mean, ultimately, we're all competing now with the high-tech firms that are out there. That is our competition. So the bar is high, but we at TradePMR are ready to meet that match and provide those tools to bear for firms like yourself to get great client outcomes. So again, thanks for having me on, Matt. Really appreciate it.
You bet. Thanks for joining us today, and we'll see you next time.